Today, we're going to complete our series on investing for retirement with the introduction of some advanced strategies. These strategies have the potential to help you target higher returns in your portfolio by diversifying across not just different companies, asset classes, and countries, but by diversifying across different unique risk factors within those asset classes. And if that sounds like a mouthful, it is. And my goal in this video is to demystify as much as possible what all this means, show you how some of these different factors have contributed to higher returns in portfolios historically, and we'll finish with some discussion around research that shows how targeting these types of risk factors in portfolios have led to better outcomes for retirees. And if you haven't met yet, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. I help people with retirement, and I created this channel to share ideas and concepts that I'm using to help people with retirement every single day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so that you're alerted when new videos are posted. If you like this video, give it a thumbs up and leave me any questions or comments below. I love getting questions because they give me good ideas for content that I can create in the future. And of course, I love engaging with new people through questions and comments on the videos. In previous videos, we've spoken about the importance of asset allocation. That is the construction of your portfolio using the building blocks of equities, fixed income, and cash being the primary asset classes. From there, we went on to talk about the benefits of passive investing: lower cost, more tax efficiency, and more diversification. Today, we're going to finish with the addition of factor investing, some more advanced strategies within asset classes that you can employ to improve your investment outcomes. Now, when talking about factor investing, it's not always intuitive, so it's helpful to start with a metaphor. And I'm going to borrow this metaphor from Rick Ferry, who's an investment advisor, and he's written a number of books on asset allocation, which are fantastic, and he uses this metaphor to talk about factor investing. Think about factor investing as the candles on your birthday cake. The cake is your asset allocation. The icing is passive investing. You can have a delicious cake with just simply having an asset allocation that is designed perfectly for your needs. You can further enhance that cake by adding icing to it in the form of passive investing, lowering your costs, lowering your turnover, and lowering your taxes. So the combination of a delicious cake and icing is a lot like having an excellent asset allocation and passively invested in market cap weighted index funds. If you've got those two things going for you, there's a very good chance that you're going to have a good retirement investing outcome. Now, from there, you may choose to try to further enhance your portfolio by adding additional sources of risk in the form of factors. In the same way that you can have a delicious cake without putting candles on it, again, you can have a great outcome without adding factors, but factors add just that little bit of extra push, a little bit of extra power to the performance of your portfolio through time, historically speaking, and they have the potential to add some additional benefits to your portfolio going forward for retirees who are thinking about trying to find ways to further diversify their portfolios or enhance their returns through time. So first, let's start with talking about what the different risk factors are, and then we're going to move on to talk about how those different risk factors have performed through time. So I'm going to go ahead and share my screen, and we're going to talk about what some of these different risk factors are. And the first one's fairly intuitive, and this is the market factor. And the market factor effectively is that over long periods of time, academics studying historical market data have identified that equities outperform fixed income over long periods of time. And most people that I speak to about investing, people that I'm speaking to for the first time and just sort of educating about how portfolios are constructed, a lot of people intuitively understand this factor. Stocks outperform bonds through long periods of time. And then within the equity asset class, though, there are different other risk factors that academics have uncovered through the years of studying historical market data. The next one is company size. So over long periods of time, smaller stocks have outperformed larger stocks. Relative price is value stocks. So relatively cheap stocks have outperformed relatively expensive stocks. And then finally, within the equity asset class, more profitable companies or profitable firms have generated higher returns than unprofitable firms. So those are the risk factors within the equity sleeve. So over and above just equities outperforming fixed income, within the equity asset class, we've identified historically, academics have identified historically, that there's different types of stocks that outperform over long periods of time. Again, those are smaller company stocks, value stocks, and more profitable firms. Within the fixed income asset class, we see also that there are certain types of bonds that outperform over longer periods of time. The first is the term premium. So longer term bonds outperform shorter term bonds, and bonds of lower credit quality outperform bonds of higher credit quality. So the natural question is, why do these different types of stocks and bonds outperform? And the question comes back to a number of different answers, but I think that the most important answer is that there's some embedded risk in these types of stocks or bonds under which or by which investors are demanding higher returns for holding them. There's something riskier about these particular types of stocks and bonds, whereby holding them is riskier, and therefore an investor is going to demand a higher return in return for holding these asset classes through time, or these different types of stocks and bonds through time. So what is it about smaller companies, relatively cheaper companies, and relatively more profitable companies that makes them riskier? So we'll start with small company stocks. Generally, small company stocks are not as stable. They may not be as well capitalized, and they may be more susceptible in a downturn for their security prices to fall. Cheap stocks or value stocks, maybe those stocks or a stock that might fall into that category has had some recent bad news. It might be an industry that's currently out of favor. And generally speaking, investors may be more pessimistic in their expectations for relatively cheaper companies or relatively cheaper stocks than their expectations of or their optimism around growth companies or relatively more expensive stocks. Then finally, profitability is a bit of a more difficult one to intuitively understand. You think that more profitable companies, that would be a positive thing. What's more risky about a profitable firm? Historically speaking, we have seen in the data, or academics have identified, that more profitable company stocks do outperform less profitable company stocks. But when you overlay the profitability factor on top of relatively cheap stocks, or you pick out from the group value stocks that are also highly profitable, those stocks tend to do really, really well when compared just with the broad market. So the combination of those factors inside of the equity sleeve has historically led to really good outcomes for equity investors. Within the fixed income sleeve, what is it about longer term bonds that make them more risky than shorter term bonds? And the answer is that investors in longer term bonds need to be compensated for the risk that interest rates would increase or change in the future. And bondholders over the past 2 years have seen this risk. So people that own longer term bonds, as interest rates have risen, bond prices have fallen. So the holder of a longer term bond is going to demand to be compensated for the risk of owning a longer term bond. So that's why we see a term premium in owning fixed income assets. And then lower credit quality bonds are more risky than higher credit quality bonds because there's more risk of default with a lower credit quality bond issuer. So use, for example, a corporate bond may be more risky than a US government treasury bond, and an investor would demand to be compensated for taking on that higher risk. So now let's talk about how these different factors have performed through time. And we're going to focus in today's video on the different equity factors. And what you're looking at is a chart showing the different risk factors on the left-hand side and how they have performed when compared to the broad market over longer periods of time. We're going to start with Canadian stocks. What you're seeing is that in Canada, smaller company stocks between 1988 and 2022 have returned about 8.46% per year when compared with large company stocks at 8.12% per year. That's a performance premium of 0.34% per year from 1988 to 2022. On a relative price basis, relatively cheap stocks in Canada have returned 10.6% from 1977 to 2022, compared with growth stocks that returned 7.61% over that time frame for a 2.99% per year performance premium for relatively cheap stocks. And relatively more profitable stocks in Canada returned 11.56% when compared with low profitability stocks for an outperformance or a profitability premium of 5.46% per year. And we just walked through the example for Canada, but as you sort of look through the rest of the chart, you can see that in the United States, in international markets, as well as in emerging markets, these premiums have existed over long periods of time. So in other words, the compensation that investors have received historically for tilting their portfolios towards these risk factors have been significant, and they've been pervasive over long periods of time. Now, you may be looking at this and thinking, Mark, like this sounds too good to be true. And as with everything else in investing, again, there is no free lunch. There's obviously going to be some periods, potentially even long periods, where these factors or these risk factors underperform. And as we now move through the presentation, we're going to talk about what that might look like for an investor. And what you can see here is now the time period between 2013 and 2022. And if you recall from the previous slide, you saw significant outperformance of each of those factors over those long stretches of time, which were multiple decades in length in most cases. What you can see here is that over shorter time clips, and this is just under 10 years, some of these factors underperform. And you can see in Canada, for example, small stocks have underperformed large stocks by just about 1% per year. Value stocks have underperformed growth stocks by about 1.8% per year, and more profitable stocks underperformed by 1.69% per year. Now, you can see that not all the premiums were negative. There were positive risk premiums in the United States for profitability specifically, international and emerging markets as well for more profitable stocks. There was a size premium in emerging markets as well as international markets. The point here being that by targeting these additional risk factors in your portfolio, you have to anticipate that there's going to be periods of time that even though over the long pull, we expect that they're going to outperform, that in the short pull, there might be periods where they underperform. And as with all things in investing, we always want to try to be as diversified as possible. And this is sort of the second point of this chart is the reason why we want to diversify across these risk factors is that over any period of time, even a risk factor like the market factor, stocks outperforming bonds, we can't always expect that that's going to occur and show up in investment portfolios. So that's another reason why we want to consider diversifying towards these other sources of risk, smaller company stocks, relatively cheaper stocks, and more profitable stocks, because any one factor can go through periods where they underperform. So we want to make sure that we own factors for the periods of time where certain other factors underperform. We want to have other factors that are potentially holding water and potentially performing so that it smooths out our experience through time. So how have these tilted portfolios performed through time in the context of a retiree? We're at the point of the video where we've talked about these risk factors. We've talked about how they perform through time. But really the question is, what does this mean for a retiree? What difference has investing in these factors made for somebody who's built a portfolio this way over history? And what does that mean for us going forward? And there's a great piece of research that I'm going to link to in the show notes, and I'm showing a chart from it here. But the study looked at the performance of two different portfolios. Both were invested in half stocks, half bonds. One was invested just in US index funds or US market cap weighted index funds, and that's highlighted here. And then also compared it with a tilted portfolio that's tilted towards value stocks, small cap stocks, more profitable stocks. And the big takeaway here is that on a historical basis, the portfolio that is more tilted failed less often in a retirement withdrawal scenario. So historically speaking, a portfolio that targets these risk factors failed less often, which is a good thing when retirees are taking money out of the portfolio. The study also acknowledged that future returns may be different than historical returns. So it made some lower assumptions about future returns that we expect from portfolios. And it showed that once that study was reran using lower return assumptions moving forward for stocks and bonds, that in that case, the failure scenario with the tilted portfolio was again a less likely outcome than the portfolios that are just invested in market cap weighted index funds. So from a retiree perspective, lower failure rates is a good thing, both historically speaking and looking forward using current market assumptions. The other big takeaway from the study is that the tilted portfolios showed higher estate values. And what that means is at the end of the retirement period, and it was measured, or the study was done using a 30-year retirement measurement period, it showed that the tilted portfolios had higher median ending values than the non-tilted portfolios, both in the historical period that was measured, as well as the future period that was assumed using lower future return assumptions. Thank you for watching this video on advanced strategies, and thank you for watching this series on retirement investing. Today's video was a little bit more detailed. The nuances around factor investing can be a little bit difficult to grab onto at first. My hope is that you learned a foundation about what factor investing is and what it can mean for a retirement portfolio. If you're interested in learning more about factor investing, I wrote a series of longer blog posts that cover the basics of factors, and I'm going to link to those in the description section below. It introduces each factor, it looks at the performance of each factor through time, talks about the different reason why the factor exists. So hopefully, if you're interested in that level of detail, you check out those blog posts and those can be helpful to you. I'm going to continue to touch on the topics of factor investing as we continue forward with the channel. I do believe that ignoring these risk factors may mean that you might leave some things on the table as it relates to your investment portfolio for retirement. And hopefully this is an opportunity for you to learn a little bit more about what that can mean for your investments in your retirement portfolio. And we're going to finish with looking back at what we have gone through over the course of our series. We started with objectives. That's sort of the starting point for creating a retirement income investment plan. We talked about the ability, willingness, and need to take risks. Those are really the critical 3 ingredients before we can begin to even think about implementing an investment strategy. We talked about the really important role of asset allocation and how that drives so much of your investing outcome in retirement. We talked about my simple 2-bucket system, which isn't really a bucket system, but talks about the importance of splitting our immediate short-term needs away from our long-term retirement needs and how we think about those things as it relates to building our portfolio. We talked about the importance of stress testing your investment portfolio. We talked about the difference between active management, active investment management, and passive management or indexing. We talked about big investment mistakes, and today we touched on some advanced strategies. So again, thank you for watching this video. If you like it, give it a thumbs up. Leave me any questions or comments below, and I hope that you have a fantastic rest of your day. Take care.